Well, just want to thank the Nolte Insurance Group for putting this on. It's a great idea, and glad that I could be part of it. And you know, before I jump into the topic, I do have to share with you. I was putting this together last night. My 9-year-old son was walking by a couple times, looking over my shoulder, asked, "Hey, Dad, what are you working on?" So I got to give a presentation on navigating turbulent financial markets. "Oh, can I see it, Dad?" So I just flipped through a couple of the slides, and again, he's 9, and he says, "Oh, Dad, you better hope all those people have really uncomfortable chairs. Otherwise, you're going to put them to sleep." So my hope today is that you don't fall asleep. We got some really interesting topics from our perspective, and I hope you're able to glean a couple of gems from it. But let's see here. There we go. So again, my name is Dan Rinzema, Chief Client Officer at Greenleaf Trust. Essentially, in my role, I oversee our client-facing team, ensure that our clients receive the service that they expect and deserve. A little bit about Greenleaf Trust. So we're really here to provide highly customized wealth management and retirement plan administration to individuals, businesses, high net worth families. Opened our doors a little over 2 decades ago, and right now we're up to 150 talented professionals and have the privilege of serving on behalf of over 1,000 high net worth clients, as well as about 22,000 participants in employer-sponsored retirement plans. Think, 401k. All told, our clients have entrusted us with a little over $13 billion in assets under advisement. But in terms of today's topic, right? So we're hopefully going to answer 3 questions for you. Number 1, what happened in terms of the virus, the economy, and the markets? Number 2, what lies ahead for each of those? And then from a financial wellness perspective, what actions should I consider taking in the current environment to not only preserve wealth, but to also grow it? So jumping right in, this is a picture of the S&P 500 over the last 12 months, a broad proxy for the overall stock market. And going back to July this time last year, we had about a 7-month period from July to February 19 where the market went up by about 13%. And the most recent peak was on February 19. From February 19 to March 23rd, so just about a month, very steep decline, a precipitous drop of about 35% to that March 23 bottom. But over the last 4 months, since that time, we've seen the market come back by about 45%. So turbulent to say the least, as we've grappled with a global pandemic, civil unrest, and a very polarized presidential election cycle right around the corner. Similarly to the stock market, when we look at the bond market, this is a same period, that last 12 months, looking at, excuse me, the 10-year Treasury yield. And so you can see about a year ago, that 10-year US Treasury was right around 2%. And over the period of the last 12 months has dropped below 60 basis points where we are today, which all told is about a 70% drop in that 10-year Treasury. So in essence, financial market turbulence clearly present. But these are outcomes, not necessarily causes of the current situation. So I think it makes sense to start peeling back the onion and exploring the cause, starting with the health crisis that in turn became an economic crisis. So as of today, global cases of the coronavirus exceed about 16.5 million. And deaths, as I'm sure you've been following the news around the globe, are over 655,000. Here in the US, just yesterday, confirmed cases rose by about 63,000. While that's slightly less than the 7-day average, it's just about double the previous April kind of wave 1 peak that we saw. So there's really been a resurgence in cases post Memorial Day. You know, as we're watching this unfold, the interesting, or one of the bright spots or the silver linings is simply the fact that the death rate has started to come down. It appears much lower today than it did back in the April peak. And California has the highest number of confirmed cases. Florida surpassed New York as the #2 hotspot or epicenter. And a lot of the cases have shifted from the Northeast to the South and the West. So what's the solution? Well, ultimately, the cure for a health crisis has to be a medical one. And at Greenleaf, we believe there's probably 3 prongs to that. So diagnostics or testing, treatments that can alleviate the symptoms and hopefully continue to lower that death rate. But ultimately, it's probably going to need to be a vaccine. On the diagnostic front, we've already tested 40 million people here in the US, and our understanding of how to treat the virus is improving, which again, hopefully can lower the severity and keep that death rate down. But when it comes to a vaccine, we really like to think of it as many shots on goal. So there's a lot of companies out there working towards developing a vaccine. From our perspective, at least the most promising currently looks like from Moderna Therapeutics. But in essence, while we wait for the medical solution, the economy is starting to reopen. And we've actually seen some better than expected numbers lately. So the chart on the upper right shows the unemployment rate for the last 70 years. I've highlighted in those gray vertical bars recessions. Historically, the unemployment rate typically troughs or comes to a bottom right before a recession occurs, and then usually peaks after that recession. So you can kind of follow it through all the way those recessions from 1950 to the most recent prior one, the 2008 financial crisis. And today, the blue line on that upper right-hand chart, again, is just simply the unemployment rate. So 2008 financial crisis, we peaked out right around 10%. But here more recently, during that March, April time period, we went from basically a 3% unemployment rate all the way up to 14.7% unemployment. June numbers, however, unexpectedly beat what most economists and experts thought was going to be the unemployment rate, dropping it down to 11.1% as of the June number, as people started getting called back to work. The charts on the lower right, continuing jobless claims and initial jobless claims, you can kind of see that those are improving as well, but they both remain very, very elevated. And as a consumer-driven economy, when people lose their jobs, you'd expect them to spend a lot less, right? But in this case, many people being stuck at home, even those that have had no changes in employment or income, are spending a lot less, right? So we're not going out to eat as much. We're not taking vacations and so forth. So the chart on the upper right looks at retail sales over the last 70 years. Again, highlighting those recessions in the gray vertical bars. In essence, really the takeaway from this chart is typically in a recession, retail sales, retail spending drops compared to where it was a year ago. And it drops into the negative territory. And so in April, we saw a decline in retail spending of 20%. Put it in context, 2008 financial crisis, at the worst point, retail spending had only fallen by 10%. So double the drop in retail spending, which as a consumer-driven economy, the consumer accounts for about 70% of economic activity. Now, as a bright spot, here in June, the retail sales on a year-over-year basis actually started turning positive. So June 2020 compared to June 2019, retail sales were actually up by 0.5%. So huge dramatic drop off, 20% drop in April, another 6.5% in May. But as of June, we've seen them start to tick back up. The middle chart there, savings as a percentage of disposable income, you can see during that same time period, savings jumped from high single digits all the way up to 30%. and they've stayed relatively elevated during this period, way in excess from a savings perspective, what we've seen for decades, really. The chart on the bottom right is consumer sentiment. So this is how do consumers feel about their situation in the economy. We have seen a dip. You can see that it dropped down here recently in 2020, but it still has not dipped below the 2008 or even in 2011-12 when there was fear of a double dip recession. So the consumer is actually more confident than most people would have expected given what we've seen in unemployment and in the savings rate. And there are some signs of economic life, right? These charts tell the story that we've probably all felt. In the upper left, we're showing here in the blue line, 2019 TSA number of travelers. So how many people are flying? This is millions of people. In each of these charts, the red line is the experience that we've had so far in 2020. And upper left, again, number of travelers, you can see it dramatically fell off a cliff, but has started to tick back up. Again, those signs of potential life there. The lower left, gasoline consumption, fell off a cliff in April, starting to tick back. Similarly, hotel occupancy in the lower right. And as someone who loves to eat out, on the upper right, we see the seated diners at restaurants year over year. So dropping for the month of March through most of April, basically to zero as everything was closed. And now we're seeing things start to open back up slowly in a socially distanced way. And you can see that seated diner starting to climb back up as well. So when it comes to the stock market, we looked at the dramatic drop. We started off with that 35% decline, followed by a 45% gain. Still not back to where we were pre-crisis peak. But the recovery has been pretty wide, and this chart looks at all the different economic sectors, highlighting with the dark green bars how much their max drawdown, or from the previous peak to the trough, how much value on average those stocks lost, compared to, in the lighter green bars, since we've seen this recovery, how much of their prior 52-week peak have they regained? So for instance, far left, energy, right? So energy stocks on average lost about more than 60% of their value, and still they have a long way to go before they re-achieve the previous peak. On the far right-hand side, you look at technology. Technology had a lower drop than the broader market, only lost about 30% from peak to trough, and has already exceeded that previous 52-week high. So technology as a sector, the average stock in the technology sector, is actually trading higher today than it did pre-coronavirus. And when we look at bankruptcies, right? So we've seen in the news some pretty high-profile bankruptcies, but they've really been relatively concentrated. On the right-hand side of this page, you can see that consumer discretionary accounted for about 40% of bankruptcy filings on a year-to-date basis. Brooks Brothers, J.C. Penney, even Chuck E. Cheese, but in essence, so far this year, it hasn't really been too far out of the norm. The chart on the left is looking at the total number of bankruptcy filings, comparing this year, the dark blue line with the dots, to the last couple of years. And really the big takeaway here is, so far, we really haven't seen much difference than previous year trends, despite what's going on. And, consumers and businesses, in essence, have really benefited from the massive government intervention. So let's take a look there. This intervention that has really kept us probably from falling into what could have been another Great Depression type scenario comes in two forms: fiscal and monetary stimulus. On the fiscal front, we've seen nearly $3 trillion be pumped into the economy from the government in 3.5, we're calling it 3.5, you can call it 4 phases. The largest of which, that third column there, is the $2.2 trillion CARES Act. And a large part of that CARES Act was direct payments to individuals, but in addition to that was greatly enhancing the unemployment benefits. Those that did lose their job not only got the normal unemployment benefit, but the CARES Act greatly increased that. On the far left-hand side here, that phase 3.5, I'm sure many of you are quite familiar with the PPP, or the Paycheck Protection Program. This, in essence, provided money to small businesses, trying to keep them afloat, with the understanding that if it was used according to the stipulations in the program, essentially it would be a forgiven loan, or essentially free money. In addition to this $3 trillion that's already been pumped into the economy, Congress is looking at a 4th wave of stimulus and debating exactly what that might look like. Earlier this week, Republicans in the House, I believe, put out their plan that's currently being debated. So as PPP kept small businesses afloat, that Paycheck Protection Program, those forgivable loans, it was really the CARES Act that expanded unemployment, keeping many families afloat. So this chart is really trying to get at the massive amount of benefit that was coming through, and it tries to compare what families were receiving previously to what they're receiving now. So in the light blue section of each of these bars, that's the normal unemployment rate. The dark blue bar is that additional benefit that families receive under the CARES Act. And the biggest takeaway here to read from this chart is essentially 90%. That's worth repeating. Almost 90% of those receiving unemployment, the benefit that they're receiving is actually more than they were earning when they were employed. So on the far left-hand side, you can see that about 37% of those receiving some form of unemployment were 200 to 300% more in benefit than they were earning when they were employed. And in fact, the average individual receiving unemployment benefits right now, the average individual is receiving 134% of what they were previously making when they were employed. So now, well, the CARES Act unemployment benefit is set to expire at the end of July. And really, from our perspective, one of 2 things could happen, or one of 2 impacts. Number one, we could see people going back to work and filling some of those help wanted signs that we see popping up everywhere. Or I guess, or 2, we could see disposable income go down and retail sales start to dip negative again. So this is something that we're watching very, very closely. All right, so we've seen how trillions of dollars in stimulus is currently holding up the economy. The next logical question that you probably have is, how on earth are we paying for all this, right? And the answer, pretty simple one, is government debt. These charts show the actual federal debt and deficits in green. So what's actually been the occurrence from 1990 to present, those green lines. The previously assumed or projected trend line pre-coronavirus, pre-pandemic, was that blue. You can see how it extends. But as of May, when everything got reforecasted, given this massive stimulus, we've also included a 2020 data point as well as a 2021 data point from the Congressional Budget Office on expectations around debt and deficit. And we see in 2020 on the upper left-hand chart, so just a deficit, meaning how much does current income exceed or fall short of current expenditures. The deficit for 2020 is projected to be about $3.7 trillion, right? As a percentage of GDP, that's in the high teens. But if we look at not just the annual deficit, so think, your budget deficit, if we flip to the right-hand side of this page and we look at the cumulative debt from over the years, we see that by 2021 on the bottom right-hand chart, as a percentage of GDP, total US debt is expected to exceed 100% of GDP. Now, ironically, despite these higher debt levels, the expected interest expense in 2020 is actually projected to be lower than the interest expense that the government paid in 2019. You say, how on earth could that be? Well, you flip back to that that second slide we looked at on the 10-year US Treasury, dipping from 2% a year ago to roughly 58 basis points right now. The burden of that debt, how much you're paying back on it, that interest expense has come down so much that even despite this higher debt level, the total outlay to service that burden is lower. Now, interest rates on a go-forward basis, that's going to be a major question. So that's the fiscal side of the coin. Looking at the monetary side of the coin, and I know what you're thinking, oh my goodness, there's a lot going on this slide. Don't worry so much about all the details here. If you want to dig really deep into it, you will be receiving this presentation afterwards and go into all the details. But really suffice it to say that the Federal Reserve, from a monetary perspective, has stepped in and said that we are committed to backstopping liquidity in the markets. We are not going to, we're going to do everything in our power to ensure that there is not a liquidity crisis like we saw in 2008. If you use an analogy, it's kind of like the Federal Reserve showed up to a knife fight with a bazooka. But oddly enough, even though they've committed all these dollars as a backstop, they really haven't had to spend much of it. So again, show up to a knife fight with a bazooka simply by having that in hand means maybe they don't have to fire it. So confidence has been brought back to a lot of the credit markets. So when we try to roll all that together, kind of that look back, look forward, we've seen coronavirus cases resurge. We've seen a new outbreak in the South and the West. However, financial markets largely shrugged it off. Economic data has been coming in slightly ahead of expectations. But the recovery that we've seen, we're watching it very closely, concerned we may start to lose momentum as states suspend or they reverse some of these reopening plans. And when you think about the uncertainty surrounding not only the virus, but also the election that's coming up, we would view lingering turbulent markets for the rest of the year. That's kind of on the con side of things. On the pro, low interest rates, monetary and fiscal stimulus, in our expectation, should help sustain the recovery that we've seen start into 2021. But this week alone is another big week. Again, we saw a phase 4 stimulus bill from the Republican version earlier this week. The Federal Reserve announces later today a rate decision, possibly reveals some plans for longer term support of the economy. From an economic perspective, this week we'll see GDP numbers, initial jobless claims. The new data point comes out on Thursday. Consumer sentiment comes out on Friday. So a really data point heavy week that we're in right now as well. So with all this uncertainty and turmoil surrounding the virus, the economy, financial markets, we want to ask the question, what actions should I take now to not only preserve, but also grow wealth? And, our recommendations are pretty simple, but we believe they're profoundly impactful. And so number one, if you have a written financial plan, now is a great time to review it. If you don't, there is not a better time to establish one. Number two, now is more than ever the time to maintain discipline. And number three, you really need to leverage the current environment in a way that uses the current landscape to support that long-term plan or that strategy. So let's start with number one, establish or review that written financial plan. What are the key components of a financial plan? And we believe that a financial plan should provide really a thoughtfully crafted, almost mosaic, where all the pieces of the puzzle fit together, because successful investors know that a purpose-built plan is really foundational to successful wealth management. You know, understanding goals and objectives and cash flows, balance sheets, time horizons, unique circumstances is key, so that the plan that you establish can really serve as the rudder to navigate through choppy financial waters. So this page really reviews the 10 components that we at Greenleaf Trust at least believe are key to a comprehensive financial plan. Along the top in those dark gray boxes, each of those 10 disciplines or areas of financial planning. The boxes underneath it, maybe less important. Again, you'll have a copy of this if you want to look at it. But those are all different areas to think about as you're developing that plan. At its core, cash flow planning, how much is coming in, how much is going out. Insurance planning. Nolte is a great resource in this regard. Investment planning. Hey, what are my goals? When do I want to retire? And what type of assets do I have to support that? Education planning, if you have kids you're sending to school. Retirement planning, income tax planning, estate planning, if you're charitably inclined on the philanthropic side of the coin, even financial coaching. So the emotional toll that turbulent markets can take often have people doing the exact wrong thing at the wrong time. You know, we try to buy low, sell high, but fear often has us selling at the bottom or buying at the top if we're not disciplined. But you know, it's not enough just to have a plan. You really have to actively monitor progress, especially in light of the current environment. You know, number one, have tax laws changed? Have my retirement goals changed? Do I want to work? Do I need to work a few more years, or do I want to retire early? What's going on that job front? You know, has my health changed? You know, that could really change the plan. But we really view it unless the headlines in your life. So think, you know, again, health, marriage, baby, divorce, job loss, kind of those headlines in your own life. If those headlines don't change, the headlines in the newspaper probably shouldn't change the long-term plan or long-term strategy that you have. Now, that is not to say that the shorter-term tactics don't change, because they do and they should. And you really need to leverage the current environment, which we'll get into during that section. In essence, the short-term necessitates an evolution of the tactics in that plan, but the long-term plan that you develop really probably doesn't change unless something changes in your life. And why is that? Because it identifies what's most important and what measures can be taken to protect in these type of periods of turbulent markets, of which asset allocation and diversification are probably our most powerful tools. So starting on the asset allocation front, you know, this chart really talked to the point that roughly 92% of a portfolio's overall return stems back to the asset allocation. How much do I have in stocks? How much do I have in bonds? What gets a lot more attention oftentimes is which stocks am I picking, or can I time the market? And studies show that those factors account for much, much less than simple asset allocation. And, you know, why is that? Well, it's because having a plan and staying the course is hard. But I want you to hear loud and clear, staying the course is not the same as set and forget it. It is simply a disciplined approach to meeting very specific goals. And it works, again, because it's hard to do. It's hard to stay disciplined. It's hard to keep your head when others are losing theirs. It's even harder to rebalance out of assets that have done really well in a crisis, like a U.S. Treasury, into those assets that have done poorly, such as stocks. But but it's that level of conviction and discipline in this approach that historically has characterized successful investors. So the next component, if asset allocation is one of the best tools, diversification is another. And again, this is simply the concept of don't have all your eggs in one basket. This chart depicts how it feels to be diversified. And our mind sometimes plays tricks on us. That 2000 to 2002, think the dot-com crisis era, the S&P 500 at that time lost about 39%. A 70-30 diversified portfolio, 60-40, 60% stocks, 40% bonds during that same period lost a lot less, but it still lost money. So 17 and close to 18% loss compared to 39. But our mind tells us, oh, that doesn't feel good, I lost money. And during the 2003-2007 expansion, markets were up 83%, that diversified portfolio only up 73%. Oh man, I didn't make as much money. Not only did I lose money before, now I didn't make as much money. And mind plays the tricks throughout this. But in the end, if you roll down to the green bar at the end, throughout these periods, despite feeling bad during downtimes that I lost money and feeling bad during up times that I didn't make as much, when you look through that noise, that diversified portfolio actually ends ahead. So looking at it from the perspective of, hey, this is not a short-term game. The portfolios that are structured to support those larger goals, whether it's retirement, education, estate, philanthropy, whatever it may be, having a diversified portfolio, even though it may not feel good along the way, ends up winning in the longer term. And so let's look further back. Let's go through and study history. And I guess what I'm trying to say, the biggest takeaway is that history favors discipline. Over the last 150 years, we've been through wars, pandemics, recessions, depressions, natural disasters, man-made disasters, political upheaval, you name it, right? So we've had it all. But what happened in each of those crises? Well, the market met its floor and it recovered. Even the worst market declines have generally been followed by significant recoveries. And while no one knows exactly when major market drawdowns are going to occur or when recessions are going to occur or how painful they'll be, we know they will occur. In fact, they're part of being a long-term investor. And we really rely on them to provide outperformance in periods that follow. So this chart simply is just looking at every single recession going back to the Great Depression, looking at the return in the 12 months before that recession, the total return in the stock market during that recession, and then the total return in the 12 months after that recession. And if you look at the bottom of this top chart, you can see the median and average. Most recessions last about a year. Leading up to them in the 12 months before the recession, markets return about 11%. During the recession, the average loss is only about 4%. And the median is actually a positive number, but most importantly, that year after. On average, roughly a 20% return with a 14% median. And so we slipped into the recession here in March, and one of these data points is known in the current recession. That chart on the bottom, the 1 year prior, we saw an 8.2% gain in the 1 year leading up to this recession. So far, again, started in March, so this takes out some of the February numbers that were included in the 1 year prior. But so far during, markets returned a positive 4.9%. The big question is, hey, what's the 12 months after going to be? Increased volatility and headlines surrounding these key issues, the virus, the economy, the election, are going to make disciplined investing more difficult today. But if history is a guide, having that discipline not to go to cash at the bottom or add additional above a target asset allocation at the top tends to provide the best outcomes for investors. But what about market timing, right? So this is the siren song that calls to so many investors who think, hey, I really want to try and time the market. Again, a lot going on these charts, but in essence, the market is going to beat a cash allocation over a rolling 1 year period about 70% of the time. You extend that out to 10 years, it's closer to 90%, 20 years, it's 100%. So timing the market is pretty much impossible to do, if not incredibly difficult. But you might be saying, hey, we've had a good run. Shouldn't I go to cash now to avoid the next fall? Maybe, but if you do and you misjudge the bottom, sitting in cash and missing out on just a few months can dramatically hamper returns. So what we see here is, back to the Great Depression, $1 invested, what would that come to? If it was just fully invested in the market, about $6,000, that $1 would grow to. If you miss just 6 of the over 1,000 months, those 6 best months would have resulted in less than half of that return. And you probably say, okay, Dan, I hear you. Time in the market versus timing the market. But we have an election cycle coming up. Imagine what that's going to do to the markets. And we have. So we've done the research. And we look at a firm by the name of Predictit that allows wagering on election results. So what are people betting on is going to happen? And the odds would say, using this Predictit feature, that there could be a Democratic sweep. And we want to understand what actually happened in markets during Democratic sweeps, Republican sweeps, or even a blend. And what we found is that during a sweep of a Democrat, S&P on average returned about 15%, that middle chart there. During a Republican sweep, it's about 16%. The blended years where there wasn't a sweep either way, about 11% return. And so the question comes, what if I invested in a Democratic portfolio, a Republican portfolio, or what if I just ignored it all and did a nonpartisan portfolio? The big takeaway here is you're much better off having a disciplined asset allocation that ignores election results if we look at historical data. All right, so you've heard it from us. We're not advocating wholesale changes like going to cash or doubling down on stocks, but we do recommend reviewing your current situation and the portfolio that supports your goals in light of the current environment and looking for prudent moves to make that can help preserve and grow wealth. So again, while that long-term strategy doesn't change, if the headlines in your life don't change, the tactics certainly will. So I want to highlight just 5 current tactics that might make sense in this environment. A lot of verbiage here, so again, you'll have a copy of this, you can read it. But number 1, really simple, rebalance again. So if you were a disciplined investor, you probably rebalanced after the 35% sell-off in March. When your stocks were underweight, after the subsequent 45% rebound, your stocks are probably way overweight. Taking some of those chips off the table, moving back down to your target asset allocation, it's probably the right time for that in the current environment. Number 2, if you haven't already, think about doing an asset location strategy, locating the tax efficient assets in taxable accounts and inefficient assets in tax advantaged accounts. This should not change the overall, if you consolidate everything, won't change the overall profile of the portfolio, won't increase the risk, but studies have shown that simply by being thoughtful about location of assets, you can increase after-tax returns by about 0.75%. So we've talked about historically low interest rates right now as well. Now is a really unique opportunity for borrowers. If your mortgage, whether it's 15 or 30 years above 2.5 or 3%, could be a great time to refinance. For those with larger estates, the interest rate that's used to value interest in assets that would go into a grantor retained annuity trust or a qualified personal residence trust, they're at historic lows right now as well. So for those in quite large estates, now is the perfect time to think about shifting wealth to future generations to avoid gift and estate tax. Intra-family loans, the applicable rates down to 1%. Strategy here might be for those with large estates, if you know you're going to be gifting or leaving assets to the next generation, maybe you start doing that a little bit sooner so that the growth stocks that you would buy in your estate are actually bought in the next generation's estate through an intra-family loan. So all that growth escapes the gift and estate tax. Now is a great time to consider a Roth conversion. With the RMDs being taken off the table this year, tax rates being low, might be a great time to do that. Also, given the current regulatory changes, might be a great time to optimize how you're giving to charity. So a qualified charitable distribution from an IRA totally avoids even hitting your tax return, so it doesn't impact your AGI. Additionally, the CARES Act gave some unique features where you can deduct up to 100% of AGI with charitable gifting for those that work their tax return that way. For the taxpayers that don't itemize, there's even above the line. Small, it's only $300, but it's an interesting opportunity in the current market. I know we're running out of time here, but in summary, talk about a time of uncertainty and turbulent markets, global pandemic, social unrest, polarizing election cycle. How does one stay not only safe and sane, but also financially healthy during this period? Again, we believe having a purpose-built plan, kind of that North Star to guide you, staying disciplined within that, not being thrown to the side, really looking at the headlines in your life versus the headlines in the newspaper. And then taking advantage of the current environment so that you can maximize that tactical play within the portfolios supporting your goal. And with that, thank you very, very much for your time today. Again, a copy of this presentation is available. I think we have time for probably 1 or 2 questions.